Welcome to TheoTrade. This is Don Kaufman. It's December 11th, 2019, and you are watching the TheoTrade evening video. Tonight, we'll keep it short, we'll keep it sweet. Market risk is still ever persistent, even after the Fed. Now, a lot of people may have tuned in to Jerome Powell. Maybe you didn't. Listen, we didn't expect much on the front of the Fed. What we did kind of expect, though, is during the Fed press conference to maybe get a couple of words about, all the funding of the repo market. If you've been watching that, some of the repo operations. Listen, Jerome Powell, he came, he saw, he was highly, highly guarded in any conversation, okay, that really persisted, especially inside of the Q&A. And therefore, the markets, of course, they didn't move that much. The one area, though, that begs to kind of be looked at and questioned is, so risks in the market, and we're going to get into the VIX here in just a moment, and the VVIX, they have really amplified in recent days. And again, none of the risks have really backed off much of anything. Again, and we just passed through, the Fed meeting, the much anticipated Fed meeting, which amounted to absolutely nothing. So let's dig into it, and I'm going to explain precisely, what we see and what we see more importantly moving forward. First and foremost, the S&Ps closed up on the day. Well, you can see they're still moving a whopping 7 handles. I mean, for the most part, massively unchanged. But there's a bit of divergence, if you will, in the force. You have the financials, which have started to slip a bit to the downside. They're down about 0.3%. Now, I've told you day in and day out recently, you got to watch the financials, because the entire rally recently in the S&P 500, this was really brought to you by none other than the XLF. I mean, that was the rally inside of the broader markets. Of course, people are inevitably going to, no, it's tech, it's this, it's that. It's all right now about the financials. On a percentage basis, the comeback they've had on a year-to-date basis has been nothing less than phenomenal. The financials, on a year-to-date basis, just a few weeks ago, were massively underperforming, now up 26%. So the financials, again, they got us here. They led us to where we're currently at inside of the S&Ps. So they backed off a little bit today. Now, rightfully so. The financials should back off given the fact that the bonds have bid up a little bit. Again, bonds going higher kind of takes interest rates down. As interest rates come down, it's not exactly a positive note for the financials. But all of that aside for a second, it's still about the risk metrics. And after the Fed announcement, you would have anticipated that risk would have come out. I mean, like a vacuum. Literally, he's done on stage, pull the risk lever, all the risk effectively comes out. And in this case, I'll use the VIX to kind of start off and kind of further this case. But it isn't even necessarily the VIX, that I use personally to measure some of that risk. If you take a look at the VIX, in recent trading sessions, specifically, earlier this week, Monday, the VIX vaulted back to the upside, all the way back, hitting even into almost the 17 handle just yesterday. But the risk really picked up in the last couple of trading sessions. And today, again, after the FOMC, you would have expected it to abate. What the marketplace is telling us, though, here is pretty straightforward. It's saying, the Fed, whoever they are, don't worry about them. Tomorrow we actually have the ECB, the European Central Bank, right? Yeah, but don't worry about that either. It appears all of this risk, is all about China. At this point in time, the marketplace, it's putting all of this persistence of risk about the trade deal. And in that case, none of the risk wants to abate. Now, the much more entertaining area, I think, of this marketplace isn't necessarily the VIX. Sure, it backed off a little bit, some 4%. But again, it's been up. And again, if you take a look at this on a percentage basis, just in the last couple of trading sessions, I mean, the thing was getting crushed and has rallied up, 15 plus percent in one trading session to give back some 4% after getting through a major event. That speaks volumes of the marketplace. But again, not what I'm looking at. Let's cruise to the bottom of the screen over here. We've got to look at the VVIX, the volatility of the volatility index. Because again, what speaks volumes isn't what you think about a marketplace. It's always what you know. And what do you know? The VVIX, it's up again some 4%. The VVIX is a measurement, okay, of risk inside of the VIX itself. And professional trading firms, when they're starting to feel a little edgy, they'll go into the VIX because they'll go into the VIX options, right? That won't influence the VIX itself. It's influencing the VIX options. The VIX options, okay, aren't influencing that underlying VIX. The VIX is at 15. It backed off a little bit. Push it aside for a second. You have to recognize the VIX options are used definitively to hedge, okay? Now, it's also a little bit alarming that the VIX options themselves, okay, have traded effectively twice the norm. Now, that's twice the norm of the previous 5 trading sessions. And even more interestingly in all of this is that the puts inside of the VIX traded really, really heavily, okay? So we're actually getting volatility increasing right now, okay, in the VIX options, and they're trading huge numbers of puts. By the way, if they're trading huge puts, does that mean, okay, that the VIX is likely to fall? Not necessarily so. You don't know why they're trading those puts, okay? In some cases, they could actually be selling a tremendous number of puts to finance the purchase of calls. So don't look on the surface and think that this is going to be bearish for the VIX. It could actually be, again, quite the contrary. They could be selling 2 times the number of puts to finance calls. If you've ever looked, for example, at some of the VIX pricing, you'll notice that the puts trade for about, half the volatility, not even half the volatility in most cases, as the calls. But all we know about the VIX options is that if the volatility of the VIX, okay, which is the VVIX, if that's up, there's risk in the air, and it's up. Now, okay, the last thing I'm going to kind of leave you with on this particular front before we actually move a little bit forward is that the VVIX, anytime it crests into about the 110 region, which it's close to at this point in time, right? Anytime it gets up there in and around like 110, the marketplace turns into literally Mr. Toad's wild ride. All right, so we're going to go ahead and we're going to pull up the SPX, better known as the mother of all products. I'm going to come down here and I'm going to go ahead and turn off all the expected moves, blank the chart, clean it up. I'm going to come up to studies. I'm going to go down to add study. Okay, all the way over here to compare with. Go to custom symbol, type in VVIX. Now, what I'm trying to do, okay, is just do a comparison chart. Now, it's not exactly clean to pull up the SPX versus the VVIX, but the point is, okay, if you look on the right-hand side, there you have, okay, effectively the SPX. On the left-hand side, you actually have the VVIX. All right, so I have the left and right axis. And this is something I was doing during trading hours, but I wanted to make sure that we included it in the video in case anybody missed that. Now, cruise down over here, come back to like the last 3 years. All I want you to do, okay, is to take a look at this and just draw a line right there, okay? It's about the 110 region. Anytime we're above 110, let's just quick point. There you go, you're above 110. What was the S&P doing? Mr. Toad's wild ride. Okay, here's a brief and fleeting moment above 110. Look at this. The marketplace coming into it, absolutely wild. Here, we have wild movement above 110. The marketplace was absolutely tanking. This is any time over the last 3 years, right? Obviously, this is one of the highest VVIXs recorded. Okay, that was actually called the VIX explosion. We can actually point out in every instance, okay, in recent history, the VVIX getting above Okay, the 110 region, markets sheer turmoil. That's the only point that I want to make. So at this point in the game, okay, you have to basically sit back and get ready for some big time movement. You can't think about positioning yourself extensively right now because you're in a coin flip kind of situation. The last risk metric that I want to give you, this is a very, very short term risk metric, right? The VVIX, listen, the VVIX getting above 110, that tells you risk could be coming anytime here in the near future, but the near future being maybe even a couple of weeks out, right? You're thinking Christmas is coming, it's all over, okay? Except the VVIX is getting up there. Now, this is extremely short term. This is just for Thursday and Friday. Listen, this is the expected move in the week. We were looking for a $42 move higher or a $42 move lower on the week, right? What do we have right now? Absolutely nothing. Look for heavy, okay, swings in the marketplace in the next 2 days of trade, just Thursday and Friday. Okay, I would be very surprised if we not at least tag the upper or lower edge of an expected move, which effectively means you're going to have 40 points of movement in the SPX. So as you take a look at the SPX, in the next 2 days, what do you got? You got $25, okay, of anticipation of movement left in here. Nevertheless, we're in a catch-22. We just haven't made a substantial move this week. Prepare yourself for just that. Thanks, everybody, for joining us here. TheoTrade. Have a wonderful evening. Bye-bye.